Hello everyone, welcome to our Egyptian online seminar group. First, Krim then if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming again Professor Cesario Mateus. Cesario is a full professor of finance at Aalborg University and honorary full professor of finance at Liverpool John Moores University. His research interests including asset management, mutual funding, performance and style investment, corporate finance, capital structure, cash holding, taxation, private equity, corporate governance, regulations, supervisory board, and bank risk taking, and SMEs and family business. He has worked at various universities in various countries. He is a founder of the Finance, Economics, and Banking Research Network, editor of Investment Analysis Journal, and associate editor of International Review of Financial Analysis. Now we will start our seminar with dear Professor Cesario Matos.
Thank you very much for the very kind introduction, and it's my great pleasure to be with you all today here. I heard from Mohamed in this pre-seminar that this seminar has been running for more than 5 years, starting March 2020, and already organized more than 250 seminars. So I was impressed with the capacity of working and organization of these seminars. And I also realized that more likely it was running out of people. That's why he invited me today to present a paper, because after having 250 colleagues before, he should be already struggling to find another academics to present their work. So, as I said, it's my great pleasure. I will share my slides to follow up and follow from there what are the aims of my presentation today. And as Mohamed said in the beginning, so feel free to interrupt me during the presentation. Otherwise, there will be dedicated time at the end as well. I believe that you can see properly my slides, right? Yeah, is everything good?
Yes, good. Excellent.
Yeah, I believe so. Okay. So basically, for the last 10, 15 years, I've been dedicating my time in terms of research to investigate in terms of long equity mutual funds and performance persistence, if there is winners that we can identify. So that's my core research for the last 10 years. And today, I'm going to present in first hand, I can say, a very preliminary work that is an extension of our most recent paper with my long-term co-authors. So Irina Mateus from Católica Porto Business School in Portugal, and as well Natasha Tudorovic from Base Business School. So this is a very preliminary, so it's very early stage work that I'm going to share with all of you, which is an extension of a paper that we published, the most recent paper that we published in this area, something like 1 year or so, where you introduce a new model that will be a new asset pricing model or an extension to the existent more used models that will allow to identify, according to our view, what we call the true winners. So we know that it's generally recognized that active investing is often seen as more suitable for stable returns in turbulent times. So we are in a very good time because there's been some turbulence in the markets, there is geopolitical risks that has been rising and rising. And so it's good times and to move in terms of being an active manager. It can manage easily, let's say this way, risk and volatility. As well, it allows managers to actively shift investments to reduce risk and capitalize on opportunities and market efficiencies, potentially leading to better performance and capital preservation during market downturns and avoid overvalued, declined assets. However, the overwhelming research point out that on average, active investing does not beat passive investing. And that's not good news. And when winners are identified, for instance, in terms of equity mutual funds, they tend to not persist, meaning that I can select a winner using historical information, past returns, or look to risk adjust performance measures like applying Sharpe ratios or the Fama French three-factor model, card four-factor model. But then they take the decision of invest, and on average, they tend to underperform passive investing. So that's why the reason where recently, and I move now to my second slide, we have been observing this shift from active to passive investing. So just to give you an idea, in the first quarter of 2025, the passive invested surpass actively, and with a ratio or a value that's $16 trillion in passive and $14 trillion in active. So that is a clear view that investors do not see the great opportunity or don't see that it's worth to put their money in an active portfolio manager when on average they tend to be beaten by passive investing. If you look to the European market, the things start still a bit different. So there is a different picture in terms of the split between active and passive. As you can see in the bottom of this slide, we talk about 9.2 trillion if you look to by the end of 2024 in terms of active investing comparing with the passive investing. So of course that's if you invest passive, you know that you have specific problems or shortcomings. There is no chance of outperforming, is even slightly underperform the benchmark index due to the fees, even though there can be very, very reduced fees and the tracking errors. So definitely they will underperform the market. And of course, as an investor, do I want to invest and track the markets when the markets are down? So that will be a problem in terms of pursuing passive investing. The other is this, which is related with the first one, is this full exposure to downturns. So meaning that if the markets will fall, a passive portfolio definitely will fall at the same time and with the same more likely magnitude if it's an index tracker. Another very important point is this concentration risk. For instance, if you look to the S&P 500, the 500 top companies in the US by market capitalization, there is what is called these mega cap stocks, the Magnificent Seven stocks, which they were representing by market capitalization something like 37%, when in 2023 they were only 28%. So they are getting more and more important of the market. And of course, if they represent almost 40% of the overall market, direction of the performance of these companies in the market will affect the market as a whole. So there is a concentration risk in terms of the passive investing in these top 7 companies. And the other point in terms of a specific problem of passive investing is these hidden costs. So there are some implicit trading costs, and in particular when you have to rebalance the portfolio, doing the rebalancing of the index, which could happen on average in a quarterly basis. So what we know about this performance in active mutual funds? So one thing that we know is that overwhelming the literature says that they do not tend to beat passive. The other is that usually, or more likely, is use models like the standard Fama French factor model and the card four-factor model to assess if the mutual funds outperform or underperform the markets after taking consideration risks like market risk, side risk, value risk, and momentum in the case of the card model. And of course, that the prevalent results as I said, is this underperformance. So a negative after fee alpha. And that is loads of evidence, as there are some authors that put here in parentheses in this slide, like Gruber, going back to 1996, or more recently, Burke and Van Biersbergen in 2012, and so on. Cubertson, looking to UK data, conclude that there is no more, and back in 2010, so 15 years ago, there is no more than 5% of the funds that can be considered as true winners. So you have to be very careful if you are able to pick up this so reduced number of funds. And more important is that even if you identify winners using historical information, historical data, they do not tend to persist in the future. So picking up a winner is not a guarantee that 1 year, 2 years, or 3 years down the road, the same thing will happen and they will keep being winners. There is another 2 points that is very important and could bias in terms of our assessment of winners and losers. One is this benchmark alpha. So it is expected that the passive index will not generate an alpha. So there is no value creation, so the alpha should be equal to 0. However, empirical evidence shows that if you regress the Faman French 3-factor model or the CART 4-factor model against S&P 500, Russell 1000 growth, or 1000 value, you find values that are different from 0 and statistical significance. And this is coming because there is an imbalance, or in the Faman French factor construction, if you go back to 1993, the authors even claim that, you know, the split between small and large or value and growth firms is arbitrarily by 30%, 30%. So, and that drives to these disproportionate weights assigned to value and small cap stocks, as it was highlighted in some recent work, including myself and Kremers and Tolle in 2012 and Chintalapati in 2017. And this bias, meaning that this benchmark index can generate a positive or negative alpha statistical significance, can be at very high value. For instance, Matalin Saez in 2007 reports no-zero Jensen's alpha, so the traditional CAPM, for a series of Russell indices that could achieve a highest value of 7.5% per annum for the Russell 2500 value index. Kremers et al. In 2012 looked to the S&P 500 and they see an annualized CART alpha of 82 basis points for this period of 25 years between 1980 and 25, which was confirmed in a different paper later on by Chintalapati et al. In 2017. Interesting is that if you look to the UK, you see that this generate alpha by the FTSE 100, which is the major index in the London Stock Exchange, is negative. So which means that a portfolio manager that will mimic or replicate the FTSE 100 is more likely to end it with a negative alpha. So an active portfolio manager has more difficulties to generate a positive alpha if the benchmark index per se has a negative alpha. The other way around is in the case of the S&P 500 in the US. Just to give an idea here in terms of how volatile can be these alphas across the time. So I just made a very simple analysis here. So I looked to 36 months of historical data of Russell 1000 value and Russell 1000 growth excess returns, and rolling over 1 month, okay, and calculate the alpha during this time series from 1992, 1993, I believe, until 2020, and see what is the alpha that is generated applying a traditional or a standard CART model. And you see that you have periods here with the Russell 1000 growth that the alpha was positive and of very 1000 value with negative value. So they can disper a lot in terms of the alpha of this benchmark. So, but there is another point that is important to consider. One is what I said already, this no zero benchmark alpha. The other is the peer group. Why is it important to look to the peer group? There is academic evidence that there is a disalignment in some of the mutual funds benchmark regarding really what is the strategy or what is the most indicated benchmark to be used. Does not mean that the situations are done because that's the outcome, that's what is expected, or that's what the portfolio manager aim. It's just because it might have been the most indicated benchmark 20, 25 years ago, and in the meanwhile it's not anymore, and is not changed or is not refined this self-designated benchmark. So there is some mismatch in terms of the mutual funds, what should be an appropriated benchmark and the one that are used. So if you look to the peer group, then you might overcome these problems. So instead of just looking to the benchmark, you should as well look to the basically the peer group. So that might be willing to eliminate this problem. There is here a question. I believe that I'm going over there. So is the MMT model combines self-report benchmarks and peer groups? How to address the potential multicollinearity between these two, given that managers often select benchmarks that closely align with their peer group style? If you allow me, I will go through that when I go to the model, and then we can discuss the potential issue of multicollinearity that exists. Okay, thank you. And so if I just go to the next slide, yeah. So for us, a true winner is what is the question about, and it was in the chat. A true winner is a fund that in a factor risk adjusted basis outperforms the benchmark and simultaneously outperforms the peer group. And of course that the peer group as a benchmark that is more common used. For instance, if you look to a peer group that reflects large growth, we identify that the most common benchmarks are Russell 1000 growth and S&P 500. That two benchmarks might account for, I don't have in the top of my head, very close numbers, but between 65 to 70%, and then it's split among different benchmarks. So there are benchmarks that are more common used, and there are other benchmarks. So that's why the peer group can have a contribution or not in terms of this. But we address to the standard card model in terms of addressing the benchmark alpha and the peer group alpha in the left-hand side and the right-hand side. So which means that we should not have these multicollinearity problems that was arise previously. Our contribution. So as I said in the beginning, this paper is an extension from previous work that we published something like 1 year ago. And in that work that I was just going to summarize in the next 2 or 3 slides, just to give you an overview, we look basically, if we make an investment today and select the winners using the MMT model, if these winners will persist in 24 or 35 or 36 months ahead. And of course, there are questions that comes from this standard or this initial approach using contingency tables to analyze if there is winners and if they exist, if they perform, if there is performance persistence. One is, as I wrote here, is so we should be able to prove at some extent that if we select a portfolio of winners today, we should be able to beat the benchmark and the peer group, not only at these two standard measures of 24 and 36 months, it could be for 6 months, 12 months, whatever is the time period, it should be consistently outperform the benchmark and the peer group. The other is regarding the size of these winner portfolios. In our previous analysis, we identify winners and we create an equally weighted portfolio of all the winners. But in this case, there are some situations that is not investable. Suppose that you have 60 or 70 winners, of course that an average investor is not going to diversify their portfolio across 60 or 70 different long equity mutual funds. He might create a portfolio with a few of them. So we should address this as well to see that independent of the size of the winner portfolios, if we are able to confirm that they persist in terms of performance. Also, we looked at long time series in our previous work from 1990 until 2020. But during this time series and during these years, there are periods of bull market and bear market. So we have the financial crisis, we have the dot-com bubble. So we have different events. It will be interesting as well to know if this identification of the winners, if it works independently, if it is in a bull market or bear market, because when we have a long time series, maybe the results are driven just regarding some good periods and then show that all the time series we identify winners that persist. And finally is trading costs. So if you are aiming to select winners, invest for some time period, and then reassess who are the winners, of course that you are going to incur in trading costs. So it's important to analyze if this trading activity or these trading costs will not at some extent cannibalize the outperformance of these winners regarding the benchmark and the peer group and the passive investment. Okay, so let's go very quickly to the model. So we start with a Carhart traditional standard model. So here we have the excess return of any single mutual fund, and then we have the market risk premium, we have the size premium, we have the value premium, and we have the momentum spread or momentum premium. So what we do is two types of adjustment. So we don't want just to know how much the return of the fund is in excess of the risk-free rate. We want to know how much it is in excess of the benchmark. But first, we need to create what we call this peer group. And the peer group is all the funds that they have the same style investing. And we use Morningstar grading table. So basically, for instance, if you look to large growth, so we have all the funds that are categorized by Morningstar as large growth funds, and then we create this peer group. They can have different benchmarks, but they represent a peer group in terms of their investment style. And that's what we call this return adjusted peer benchmark. So we have all these funds in the same category. We just calculate the equally weighted return of all the funds. Our independent variable is this equally weighted return of all the funds in the same style category, minus the return of the benchmark specific for every single mutual fund, and then we regress against the standard Carhart model. And of course, that we generate here an alpha, that is the alpha of this peer group, and we have here an arrow term that represents basically the risks or the specific risks of the peer group that is not embedded in the benchmark and is not captured by the model. This is two relevant information, the alpha of the peer group and the residuals or the arrow term of this initial regression, that we are going to combine, associate, so to add up, and use as an additional factor in terms of our analysis. But the reading of these betas coefficients are now different. For instance, if you have a beta on the coefficient on the factor of SMB, as I wrote here, of 0.05, this means that the peer group has 5% more small caps stocks than the benchmark. So basically, you have to have a bit of zero to say that the peer group has this risk factor at the same way that the benchmark. So these positive betas or negative betas is in excess of the beta of the benchmark associated to this factors. So to account for this benchmark alpha and idiosyncratic risk, so now we are going back to our of every single mutual fund in relation to the benchmark, and then we include as well this new term. And this new term will help us to capture all these specific risk of the peer group. And now we have this augmented alpha, which is an alpha of every single mutual fund after you take in consideration the alpha generated by the peer group and the alpha generated by the benchmark. So that will be the clean alpha. So basically, if the alpha of the benchmark is the same as the alpha of the peer group, and if one fund, mutual fund, reports specifically the same performance, so the alpha here will be equal to 0. Okay, so that's the rationale of our calculations. And of course, the beta here shows how much of the alpha of the peer group and the specific to the peer group is reflected in the return of every single mutual fund in excess of the benchmark. Okay, so let's present the empirical results in short. So basically, I'm not our initial paper that I refer some of the parts here look to different style characteristics. So we look to large value, large growth, small value, and small growth. In this extension, I'm going only to present what are the results to large growth US long only equity funds. And so the data goes from 30 years, from 1990 to December 2020. We already extend the work until 2025, and the results hold. So they are qualitative similar, which means that identifying winners, they persist. The sample is free from survivorship bias. So if a fund is dropout, we use all the available information until that time. We use the oldest share class selected following previous work in the area. All returns are net of fees and inclusive of dividends. And just to give an example, and as I said before, even though there is an overwhelming benchmark to large growth funds of the Russell 1000 growth and the S&P 500, all these 785 mutual funds report 34 different prospectus benchmark. Okay, so that's very important to consider that. Okay. There is a question here. I noticed that the analysis focus exclude category. Well, in the previous paper, we looked to 4 categories. So the ones that we consider to be more distinctive in terms of the analysis. So we look to large and small value and growth. We didn't look to blend, and we don't look to mid-cap mutual funds. So these 4 styles are the ones that overwhelmingly have the most number of funds. In this extension, we start by looking to large growth, but we are extending in terms of other style characteristics. So we pick up the style that we have more availability of mutual funds, 785. That was our rationale. And we believe and trust that the results will not differ to the other categories, but we are still working on it. So that's a very preliminary version that we just present in terms of large growth. And it was also because since we are going to analyze bear and bull markets, we know that growth firms and growth stocks are the ones that were more affected during the dot-com crisis, and we want to large growth. And as well, moving to the presentation, Morningstar provides information, all this information in terms of the fund's primary prospectus benchmark and the benchmark's total returns. Okay. So just to give an overview, so 785 funds, we have around something like 14 years on average of data, so 178 months on average of the mutual funds. As I said already before, 34 different benchmarks, prospectus benchmark, and then we have the fund size, net expense, and the manager tenure is around 10 years, which is quite long tenure on average. Okay. Just to go back to the previous paper to give you an idea how our methodology, the MMT model and the CART model differ in terms of giving us the results. So the first thing is that if we calculate the alpha for every single mutual fund using 36 months of data and rolling over 1 month during all this time series of 35 years, we ended to get, nevertheless, if we are in a situation of the Russell 1000 growth to have a positive alpha or a negative alpha, so we split. So in case that the index has a negative alpha, we found more positive, more winners than the CART model. So when you really have a negative alpha in the benchmark, being less negative is a winner. When the CART model demands to be a positive alpha, that's a big difference here in terms of the analysis. So if you have a Russell 1000 growth with a half of -1%, and if you have a mutual fund that is -0.5%, 50 basis points is a winner. In the CART model, will be a loser. So that's why we identify more positive alphas. Nevertheless, if it's a benchmark index as a positive alpha, in this case negative here, or positive, in both cases, we identify more positive alphas, more winners, which is already an important and expected situation. So how do we define winners and losers? So we calculate the alpha for every single mutual fund, 36 months of data, applying both the MMT model and the CART model, and we consider a winner if the alpha is positive and statistical significant at 10% level. And when we apply these contingency tables to see how many funds we have as a winner-winner in 2 different periods, 36 months, T-36 and T+36, or winner-loser, loser-winner, or loser-loser, we always apply the same criteria. So in T-36 has to be positive or negative alpha and statistical significant. In period T+36, we relax this constraint and we demand only to be positive alpha or negative alpha to consider a winner. So a winner will be considered if it's positive and statistical significant T-36 and just positive in the period ahead. We also have done a subsample imposing, and of course that we lose a lot of funds in this case, imposing that in T+36 has to be as well statistical significant, and the results hold, but we have a very small sample in this case. Just to give an overview in terms of the percentage of winners following the previous criteria and the percent of loser funds. So they can vary across the time substantially, but we are on average between 8 to 10% of the overall funds that we are available in our data set to be winners or to be losers, and all the other ones are hybrid in terms of the T-36. They can be either positive or negative, but not statistical significant. Okay? So when we apply the contingency table, what we get, and as expected, we have an overwhelming number in our model of winners that persist in the period ahead, comparing with the winners and losers in the CART model. So this is a clear indication that we are in a presence just without any statistics, but then of course that we perform the relevant test to assess that, that since we have more funds that are winner-winners than winner-losers, and more funds that are losers-losers than loser-winners, we see performance persistence in our model. And this performance persistence, as we can see here, it does not come just from the winners or just from the losers. When in the CART model, providing evidence, we provide evidence in this study that has been shown previously. If there is performance persistence, they will come more from the loser funds that tend to perform, that tend to persist, and not from the winner ones. That we have less winners that persist as a winners, and we have much more here losers than persist as a losers. So which means that the performance persistence with a CART model comes more from the losers perspective than the winners. And if we do a very simple calculation, which is identify the winners in period T minus 36, and if we invest in an equally weighted portfolio 36 months ahead, what will happen? And what will happen is that if we invest in these funds from our model, so these 8,748 funds across all the time series, we beat in a year basis or annual basis the benchmark, the peer group, and the CART model by these 77 basis points in annual basis. And if we do in the losers, we are beaten by 40 basis points, which was expected because they underperform. We have also done some, which I consider interesting analysis, because some of the funds, of course, are considered winners and losers in the MMT model, but they are as well considered in the CART model. So we just look to the case of the winners or losers that are identified. What is these unique winners will tell us. So that's what we show in the next table. Of course, that is the reduction of the number of funds here, overall winners. But again, we identify more winners than winner-losers. And look what happens here in terms of the CART model. There are so few that are identified as unique winners. And when they are identified, just around 30% of them, they tend to persist as a winners. And much more losers are identified. And of course, that the results here, in terms of the outperformance 36 months ahead by in comparison with the benchmark, the peer group, and the CART model, of course, that goes up. And in this case, we are talking about a 1.2% in annual basis if we invest in this portfolio of winners. I don't know how am I doing in terms of time. Can you please give me some guidance?
Take your time. You have a time.
Am I okay? Yeah? Okay. Thank you very much. So let's look to the extension today to all of you. So one of the points, it was that in the previous analysis, we just looked to this 24 months or 36 months ahead, assuming this rolling window of a month. Let's suppose that investors have different time horizons. So they don't need to just be the full 36 months or 24 months. They might decide to be 18 months, 17 months, 15 months. So what we have done was the following. We calculate all the winners in this rolling window of a month, and then we look to the performance of a portfolio of these winners in the next months, 2 months, 3 months, until 36 months. So we have, if we have a rolling window, if we roll these mutual funds 300 times, we have 300 months one, and that we select the winners. And then we calculate the average of these month one returns, month two returns, and so on. And that's what we plot here. So the gray line shows from funds that are considered winners following the previous methodology, positive alpha and statistical significance, what is the return that they obtain on average in month one, month two, and month three, independently during all the time series where they are selected to be a winners. And as we can see, we are here always above the benchmark and the peer group with the same methodology, here in the line red or orange and blue. And then when we look to yellow, that represents the losers. So this graph here on the right-hand side basically represents the same thing that is here. It's just that here is the excess return of these winners per month above the benchmark and the peer group. So just basically subtracting these two, pick up the max of this, the benchmark and the peer group, and subtract to that one. Okay, and here we have done the same thing. So on average, we are around these 40 basis points in a monthly basis. So independently when we select the winners, if we do an equally weighted portfolio, on average, we tend to do 40 basis points in a monthly basis, some months on average higher than others for the coming 36 months. This is very interesting in my perspective because it does not boundary the results to say you make the decision today and how you perform after 36 months. So which means that if you drop after 6 months, 8 months or 10 months, according to this historical data that we have, you should and must beat the benchmark and the peer group even for this short period. The only thing that you have to take in consideration is itself the transaction costs and because you need to buy and sell, okay? So these trading costs, okay? So if you just do an extrapolation and say, on average, if I invest looking to these average returns of the winners in a monthly basis for month 1 to month 36, if we invest for 36 months, how much we'll get on average for $100 invest by the end of 36 months. So it's just picking up the results from the previous slide. So you get something like $143, which gives you a CAGR of 12.66% in opposition to a CAGR of the benchmark and the peer group around 6.86%. So here we calculate as the highest of the benchmark and the peer group, okay? So it's quite a difference, around 6% difference that you obtain in a year basis, okay? Another important point is, because you might ask, well, but there are different benchmarks. Overall, if you look to the full picture, how different are these benchmarks in terms of the return and the risk comparing with the most common use for this style of investing, like the Russell 1000 growth. And here you have the results. So the benchmark is basically the average of the self-declared prospectus benchmark. So when you have the Russell 1000 growth is the returns of Russell 1000 growth, and the peer group is all the funds in the same category, in this case, the 785 funds that equally weighted across the time. I believe that I have 2 questions. Okay, geopolitical risk in global financial markets. Have you considered either geopolitical events might affect the persistence of mutual fund performance? Yes. We are, with this work, we have data until 2020, and we already extend until presentation. We didn't look specifically to any particular geopolitical event, but we observe that independently when you select the winners and make investments for 1 month until 36 months, independent of these geopolitical events, you tend to beat the benchmark and the peer group. Because if there is a geopolitical event that we can consider start and end time, which is very difficult to have that in terms of identification of what is the boundary of the period, we need at least 1 year, 1.5 years, 2 years, so we can assess properly. The other question is, how do you interpret the persistence you observe in the winning funds? Well, in the positive side, I will say that there is a group of portfolio managers that they have the knowledge to identify the best buys to incorporate in their portfolios. So there is some skills over there in the market, and that might be reflected with the tenor, how many years they stay in the fund, is because they tend to perform well and attract more investors and increase the assets under management, and then they persist in these mutual funds as managers. So that's what you put as well below. Do you believe that these this reflects managerial skills. Yes, absolutely. Exposure to systematic risk factors. I will look to that later because we look to that to identify if winner funds or loser funds, if they have different exposure in terms of the factor risks independently of being in the same style category. I have a slide in the end that will address this question, if you allow me. Okay, so let's keep going. So what we have done, it was the next step is to be more investable, because the results that we provide is looking to all the winners. So the first step is, okay, let's look to all the winners, but assume that we rebalance the portfolio, let's say every 6 months. So which means that we assess the winners, 6 months later, we make a reassessment, sell in full mutual funds that are not considered anymore winners in the previous 36 months, and reinvest in a different portfolio. Okay? So that's what we have done in the analysis, which this approach should have a positive effect in terms of the performance of this winner portfolio. And if you look more than a graph, you know, there is quite here an identical performance, and then there is a kick starting in 1999, and then goes exponential until recent years. And in the right-hand side in the table, you have a more close perspective. So if we start investing in 1993 and keep the investment till 2020, rebalancing this portfolio of winners every single 6 months, you ended with a 13% return in annual basis, where the benchmark, it's very close to what is considered to be the market risk premium, you know, 6-7%. Annual standard deviation, very identical. So we are not in our portfolio picking up an extra return at the expense of more risk, and that is reflected in the Sharpe ratio, which is a substantial higher Sharpe ratio in this portfolio of winners than comparing with the benchmark. And then we calculate this break-even of transaction costs. And what is the rationale here? So basically what we have done is, the question is, how much can the return could drop? So how much the return could drop and still have the Sharpe ratio, the same Sharpe ratio as the benchmark, with the annual standard deviation of the portfolio. Okay? So assuming that we have the standard deviation, for instance, of 16.43, how much this return can drop to achieve a Sharpe ratio of 0.5288. And the break-even is 5.08% in this example. So which means that it can be spent 5% of the value of the portfolio in rebalancing the portfolio, then we'll be in the same situation in terms of Sharpe ratio than the benchmark. That's quite a buffer, because we know that on average you talk about 50 basis points if you do that twice a year, 6 months, buying and selling. So you get at the most, and already a very high value, 2%. So we still have a good buffer here. That means that even with rebalancing and transaction costs, we outperform the benchmark. Okay? So we have done an extension of the analysis. What about if instead of looking to all these winners and rebalancing a portfolio of winners, which is not investable, because as you see, on average, we have 10% of the funds, 8-10% that are winners. So if we have 700 and something, we have on average 60 funds. In some periods more, some periods less, but we have on average 60 funds to invest, which is a very high number of funds to any single investor to do so. So we make a different analysis, which say, what about if we look to just the top 5 winners? So we have this group, let's say 60 winners, and we look to the ones that are the top 5 in terms of the alpha value. We don't look to statistically significant because all of them are statistically significant. We look to the ones that have highest value of alpha, and we select the top 5. And then we follow the same methodology. We equally weighted these 5 mutual funds, and we rebalance every 6, 12, and 24 months. And the results are here graphically, and then in a table in annual basis. So we can identify a clear C from the graph. This is where the benchmark lies, very below comparing with this portfolio of winners. And that's very close between the 6 months and the 12 months rebalancing, and less the 24 months. So not so much of a difference if you look to all the time periods, 6 and 12 months, but dramatically lower if you look to 24 months. And then you have as well this break-even of transaction costs that is quite good still for 6 months, 12 months, and even to 24 months. And the returns here in the top that are much higher than the 7-8% of the benchmark during this whole time period. Okay. We also extend our analysis to say, okay, we don't look just to top 5 winners, we look to the top 10. So now we identify a portfolio of 10 funds, all of them are winners, and we select the top 10 every single period by the 24 months. And we clearly see that using top 5 winners 6 and 12 months is the best approach, following up by top 10 at 6 months, which is here dark blue, and then comes all the others. And of course that when we go to the winners, these are the ones that perform worst, even though they beat the benchmark. Okay, but the next table will give you a more clear analysis. So if you want to go for return, according to our time series that we have, we should go for top 5, rebalancing 6 and 12 months. That will give you a monthly and return per annum around 18%. But if you look to risk, so if you want to reduce risk in your portfolio, of course that you go to all winners because you diversify further. So in this case, of course that you have less return than if you go to the top winners, 5 or top 10, but you reduce risk comparing to have just a more concentrated portfolio. But looking to the Sharpe ratio, we see that the Sharpe ratio of the top 5 and rebalancing 6 and 12 months is very similar to invest in all winners 6 to 12 months, because even though they perform worst, they have less risk, which means that Sharpe ratio is at some extent comparable. One is in the top 80s and the other in the bottom 80s, but it's as I said before, we are extending the style investing, not looking just to large growth. We are doing large value, and small growth, and make funds of funds in different style characteristics. So create portfolios that simultaneously pick up winners from these 4 different styles and assess if they beat the benchmark, a composite benchmark, and if that's the case, if they achieve a higher Sharpe ratio, which means that is at not expenses of higher volatility or higher standard deviation of the returns. The results are robust, so we have some preliminary results to show that. I'm not bringing them today, but so there is advantage in terms of diversification to do these funds of funds in different style investing, because we'll achieve still a very high Sharpe ratio on returns with lower risk than just investing in a single style. Okay? So the second part, or the third part, better saying, that we want to analyze now, the first one was to say, is not only by investing 36 months that we beat the benchmark and the peer group. Rebalancing matters because investing in a portfolio of all the winners is at some extent not investable. And now, does the model, the MMT model, works in different periods? So if you talk about between dot-com bubble and the global financial crisis, if you look just at dot-com bubble and the financial crisis, if you look after financial crisis, So basically, if you are looking to stable or bull markets, or if you are looking to turbulent periods like bear markets. Okay, so that's the analysis that I will present next. So let's start. In this analysis, we just look to the top 5 winners. Okay, but if the results are robust, we believe that they should be for the top 10 and all the winners. And we do rebalance 6, 12, and 24 months as before. So this first analysis is looking to say, okay, what about between the period of dot-com bubble, as soon as dot-com bubble hypothetical terminates, and then before the global financial crisis, if in that moment we look to the previous 36 months and identify the winners and invest for 6 months and then reassess and do it again until the end or before the global financial crisis, does this winner portfolio outperform the benchmark and the peer group? And the answer is yes. Okay, so you have here the benchmark, okay, that we use for convenience the Russell 1000 growth, because we show already that there is not so much difference between the average of the benchmarks and the Russell 1000 growth. And as you can see, during this time period, on average, depending on the rebalance of 6, 12, and 24 months, you get 22% to 25% returns in annual basis, less than a half. And the Sharpe ratio is as well very or higher than the Sharpe ratio of the Russell 1000. And again, this break-even of transaction costs, it's very high. So it's not of a concern that after the transaction cost, we still beat the benchmark and the peer group. Okay. So what about after the global financial crisis, starting in 2009? So we see the same pattern. So the methodology is the same. So we invest in a portfolio and reinvest every 6, 12, and 24 months. And again, these portfolios, active portfolios selecting the winners, the top 5 winners, beats the Russell 1000 growth. And again, the Sharpe ratio is higher, and as well a safe break even in terms of transaction costs. What about in a bear market? For instance, during the dot-com bubble, okay, starting around 2000 and ended by late 2002. Here is the big story, because basically, even though our portfolio of winners provides a negative return for these time periods, this return is less negative than the Russell 1000 growth. And that applies across the top 5, 6 months, top 5, 12 months, and not the top 5, 24 months, because basically you have just here 2 years of data, which means that you select the portfolio before the crisis, and you are not able to rebalance because you're just going to rebalance after 24 months. So that's why you have very similar results between the benchmark and the winner portfolio. What about if you look the global financial crisis? Same results. We are doing better, around 10% better than the benchmark. During this time period, the benchmark lost 38% on average per annum, per year, and our top 5 winners, rebalancing 6 months, 12, and 24, they have done much better, following both the MMT model and this rebalancing of 6, 12, and 24 months. Okay. Now, coming back to one of the questions that you kindly asked in the chat, is that if there is some characteristics, some risks that some funds are taking different than others. Identify across all these time series winners funds and the losers funds. And we look to the value of the betas in the MMT model. Do not forget that the betas reflect what is in excess of the benchmark, as the example that I presented previously. And we see some discrepancies and the characteristics of the winners. And then when we narrow down to the top 5 winners, if you look to the market risk, we see that winners, on average, they have more market risk than the losers, in excess of the benchmark. And if you look to the top 5 winners, they have even more market risk than the benchmark. Even though when you compare the values, the top 5 with the winners, top 5 with losers, and so on, using a Wilson rank sum no parametric test, we don't see evidence of statistical significant difference between these values, even though the values per se are statistical significant. But let's look to this size factor. It's very interesting, the size factor, because here is missing the stars, my apologies, so it should be statistical significant at 1% level, so it's missing 3 stars over there. So if you look to the winners, on average, they have 20% more small, so they overweight small cap in relation to the prospectus benchmark, assuming Russell 1000 on average, or every single every single benchmark that is indicated in the prospectus. So you see that they overweight size, the winners. The losers overweight size as well, but less than the winners. And if we look to the top 5 winners, they even overweight more than the winners and of course the losers. And all these values are statistically significant if we do the difference between these coefficients. If you look to the value growth or the value premium, you see as interesting results as well. We see that the losers overweight value stocks when they are large growth funds. They are overweighting value stocks, when the winners and the top 5 winners, they overweight growth stocks. So which means that these characteristics here, which are different between the winners and the losers, might, and they are very helpful in terms of explaining where this extra performance or outperformance is coming from. And also the momentum, okay? Even though in the momentum, we have a clear evidence that there is overweight investment in winners, comparing with the benchmark, applies to all the 3 types of outcomes, losers, winners, and top 5, but their differences are not statistically significant. And as expected, in that extra factor that we have in the end of the regression, that is the sum of the alpha, the peer group alpha, and the residuals term, for every single 1% increase on this alpha and the residuals of the peer group, there is a 2.1% increase in the excess return of the mutual fund in relation to the benchmark, and less when you look to the winners and lesser when you look to the losers. But what I found interesting is this part here, that basically top 5 winners and winners overweight small cap, and then in the other factor, you see that losers tend to overweight value, even though they are a large growth fund, or at least they categorize themselves as such, and you have the other way around in terms of the winner funds. And I'm close to finish. So just the conclusions. We trust that this MMT model as an extension to address both the issue of the no zero benchmark alpha and the mismatch between the prospectus benchmark and the style, the characteristics of every single mutual fund is important to be included. If we include that, we are able to identify what we call true winners, and these true winners tend to outperform the benchmark and the peer group independently of the length of investment that we take and when we make the decision to invest. That's why we show that from 1 to 36 months, this tends to work very well. I have some questions here, if you allow me, before um, I start answering the questions. I stop sharing my slides, um,
Yes.
and I will start with the questions. Let's see if I don't miss. How do you interpret the presentation? Okay, this last table, I believe that to some extent has answer. Very good, all of them very good questions, you know. From practical perspective, do you believe that investors could realistically implement the proposed strategies after accounting for transaction costs, taxes, potential liquidity constraints? I think so. That's why when we make this extension of the paper, we are very convinced that instead of trying to find different risk factors and to increase the number of factors in the existence models, I think that might not be the direction because some factors might be important in some markets and might not be important in other markets. So we might not be able to use that as a general approach, like the Fam and French and the CART model. By including what is observable of this benchmark no zero alpha and the peer group, we are able to extract better who are the true winners because the CART alpha and the Fam and French alphas are biased, in my personal opinion, because since they look to absolute alphas and not a relative alpha comparing with the benchmark and the peer group. And if you are in a situation that you have a positive alpha of the benchmark of 2%, by doing nothing and just replicate the benchmark, you provide as well a 2% alpha. And that's not a winner. Okay? The other way around works against, which is to say, if the benchmark is minus 2%, how much you have to work hard to get to positive, because the benchmark is minus 2%. So you have to work very hard, you have to put so much skills in place so you can achieve the positive. Our model allows that if basically you have a negative alpha in the benchmark of minus 2%, then if you adjust minus 1.5, minus 1%, that's fair enough. You're already beating the benchmark by 50 basis points or 1%. So that's fine. No issues about that. So by extending the analysis, not only identifying the clear winners or true winners, but making it investable in the sense that you say, okay, you are a small investor, you have 10,000 pounds, 20,000 US dollars, you are not going to invest in a portfolio of 60 or 70 winners. Just go to a small portfolio of 5 mutual funds. Then you can split, you know, $3,000-4,000 in every single of them and invest your 20,000. And historical results shows that this tends to do it quite well. Okay. Okay, excellent presentation. Thank you for the opinion. I always appreciate the compliments. If you were to extend this research in the future, what you see the most promising direction? Applying the model to other asset classes or further refine the performance evaluation? I think, and we are working on that, and the results so far are very promising. Extending to other asset classes, in particular, for instance, that we have almost the paper ready with very similar results in terms of outperformance if we look to bonds, mutual funds. Okay, different story. I work most of my research in asset management more in equities, but I also teach in terms of bonds, and everyone is doing that, I believe. If you are at some extent in finance, you tend to have principles of finance or a standard course that you go through bond valuation and so on. So everyone works on that. And we extend that to basically to a bond portfolios, and it works quite well. Of course, that the risk factors here are different. We are not looking to this size factor, value factor. So you look more in terms of sensitivity of interest rates, like duration. Also, we incorporate as risk factors relate to credit risk. Okay, so all this information is provided to every single bond portfolio bond mutual fund, and the results are quite promising. So we have been applying to bonds as well. I think is the closest or the ones that at least we are pursuing and not in terms of refining the model. I think the model is working quite well. It's very simple to understand regarding the card model. It's simple extensions of the model, and I think that will go through that. And I have another question which basically relates to the previous one. Yeah, can this model be applied to fixed income mutual funds? Yes, definitely. That's what I said is an obvious extension. I think that interesting will be as well in terms of hedge funds. It will be very interesting to apply as well to hedge funds because we have scarce of information, so it will be important to look to these benchmarks of the hedge funds, where they are categorized in terms of the type of hedge funds. So how can we identify winners or not? I think that would be an interesting as well to see it. And I think is very promising in terms of the results. I don't know if I was able so far to answer all the questions. There is someone? No?
If anyone have any questions, you can open your mic and ask your
Yes,
question.
you can ask directly if you want to.
Bilhan, you have a question? If anyone have any questions, you can open your mic and ask your question.
As far
Be
as it is in English
yeah.
or Portuguese.
Thank you very much, dear Professor Cesario, for your contribution and your effort. It's really an excellent presentation, an excellent paper. Thank you very much, everyone joined to us today, and thank you very much for taking the time to present it to us. It has been appreciated, Professor Cesario.
Thank you very much for the kind invitation and keep doing the great work that you have been done so far, dissemination research, make it available to everyone worldwide coming from Egypt. So that's quite a big achievement. And I was, as I said in the beginning, impressed when you told me that you organized already 250 of these seminars. And believe me, as I told you off the record before we start, I know how much time will take to organize a single one. So you might be working more than 24 hours a day. I don't know how can you do it. Besides your university commitments, your own research, also dedicated to this. Once again, thank you very much for your
Yes,
invitation, and it was a pleasure to being with all of you.
my pleasure. Thank you very much, and I hope to see you soon in Egypt. You are very, very welcome.
Thank you. I never been to Egypt, so it's always a possibility. Thank you very
Yes,
much.
you're welcome.